Hello everyone. In this recording we're going to go through some of the homework for Chapter 2. And in Chapter 2, this is where we were starting to introduce the different classifications of costs and also cost behaviors, how costs behave. And of course, the most important part for accounting purposes is understanding this concept of preparing the cost of goods manufactured and how that is incorporated into the cost of goods sold calculation. So a couple of warm-up exercises here. We're taking a look at cost behaviors, and basically costs behave in one of three ways. We have variable costs, that's number one, where the variable cost per unit remains the same, but as activity increases, so will the total. Number two, fixed costs. Fixed costs always remain the same in total, but as activity increases, the fixed cost per unit will decrease. And then, of course, number three, we have a mixed cost, where we have a cost that is partly fixed and partly variable. In a future chapter, we will look at some methodologies to break out our mixed cost between the fixed and the variable. So here, a very simple example. We've got a corporation. They use trucks to transport bottles from the warehouse to the different retail outlets. Gasoline costs, they've done some analysis. It costs about 24 cents a mile. Insurance costs are $4,000 per year. So you can see we have two types of costs. The gasoline cost is a variable cost. It's the same per unit, 24 cents per mile. All right. But the total is going to change as activity changes. Insurance is a flat rate, $4,000 a year. It doesn't matter of activity. We can drive 0 miles a year or 20,000 miles a year. It's still going to be $4,000 a year. So we have a mixed cost here, partly fixed and partly variable. And figuring it out, we're going to calculate cost if we drove 18,000 miles a year and if we drive 35,000 miles a year. So when we drive 18,000 miles a year, the fixed is going to be $4,000 a year. Okay? So the variable is going to be 24 cents a mile times 18,000. When you do the math, it all winds up total cost of $8,320. When you divide that by 18,000, you get 46 cents a mile. Now you do the same thing with 35,000 miles. 35,000 times 24 cents a mile plus a flat rate of $4,000, you get a total of $12,400. Divided by 35,000 miles, you get 35 cents a mile. Do you see as activity increases, 18,000 to 35,000, what do we have? We have a decrease in our cost per mile. That is solely because part of the cost is fixed. If this was truly all variable, this cost per mile would be exactly the same, regardless of activity. So I hope you understand that. Variable cost per unit remains the same. All right, but the cost per mile is going to decrease as activity increases when fixed costs are present. So that's the takeaway. I want you to understand not only how costs behave, but what makes the cost per unit increase and decrease. Okay, this next homework question, very quickly, we are trying to calculate total manufacturing costs. Now, manufacturing costs, as discussed in this chapter, are basically three subcategories. We have direct materials, number one. Number two, we have direct labor. And number three, we have manufacturing overhead. So you can see the answer down here is $147,000. How do I get $147,000? Well, it's basically, like I said, the sum of direct materials, direct labor, and overhead. Now, over here on the right-hand side, you can see I'm circling it with my cursor. This is what the author gave us. They gave us this information to work the problem. They already gave us the total labor and overhead, which I'm highlighting here. But they did not really give us the total direct materials used during the year. We needed to figure that out with these first three numbers, which you can see we've done here. Basically, what you're going to do is you're going to take the direct materials inventory at the beginning of the year. So this was what was in the warehouse before we started the year. Plus, we purchased more direct materials during the year. So we started with $7,000 plus $90,000. So we had $97,000 of direct materials for use. But we didn't use all of it because we ended the year with $12,000. So $97,000 less the 12 means $85,000 was actually used in production. We will take that $85,000 and put it down here in the second calculation, and voila. We use direct materials and labor and overhead. So manufacturing costs incurred is $147,000 for the year. That is going to be part of the calculation to figure out cost of goods manufactured. That is the second step. The second step, as we see here, is computing or calculating the cost of goods manufactured and, of course, the cost of goods sold, which is a calculation that you should have learned in the financial accounting course. So in order to calculate cost of goods manufactured, you can see what we're going to do is we're going to roll forward the WIP, or the work in process inventory. So remember, there are three inventory asset accounts for a manufacturer. The first one is direct materials, the second one is WIP, and the third one is finished goods, So the WIP is when, by analyzing the WIP, that is basically what is in process on the assembly line, that is when we can calculate the cost of goods manufactured. So once again, the cost of goods manufactured is our assembly line, what has basically been taken off the assembly line and moved into the finished goods. That's what cost of goods manufactured is. So we are going to calculate it as follows. So the WIP at the beginning of the year was $14,000. And during the year, I added direct materials, direct labor, and overhead, as we calculated in the prior homework example. That is the manufacturing costs that have been added to the WIP process for the year. So the beginning was 14 plus 158. That means we have $172,000 of materials, labor, and overhead, which are the manufacturing costs. All right, on the assembly line, somehow, some way. At the end of the year, we say stop, everything stop. We need to count what inventory, what manufacturing costs are still somewhere on the assembly line. And we count $5,000 worth of manufacturing costs on the assembly line that are not yet finished as of the close of business at the end of the year. More on that in future chapters. I will explain how to calculate that $5,000 that I have calculated here, that I have highlighted. So we have to account for $172,000 of manufacturing costs. Once again, that's the materials, labor, and overhead. Less the $5,000 that's still on the assembly line at the end of the year. That means $167,000 of WIP costs have been finished. They have graduated to the third category of inventory, and that is called finished goods. So that $167,000 is going to be added to the beginning finished goods. Beginning finished goods was 16 plus the 167, which we calculated above as what was added to the finished goods, less the ending finished goods, gives you the cost of goods sold for the year. That is obviously the expense for the income statement. So I really need you to understand the manufacturing costs, which are the materials, the labor, and the overhead. And the materials, labor, and overhead are added to the WIP process to calculate the cost of goods manufactured. And once again, that cost of goods manufactured is basically the amount that came off of the WIP inventory and into the finished goods inventory. So there's a connection between all of this. Okay, I think we can skip the multiple choice questions. If anyone has any questions whatsoever, you feel free to contact me, and I will be more than happy to answer any of your questions. Real simple homework example here. Basically, it's more of a definition. We have direct materials, which are basically, what does that mean? It means all of the materials that can be traced directly to a product that we're making. Now we have direct labor. It's basically the compensation for all of the direct assembly line workers. The manufacturing overhead, you can see the word direct is not used here because this is an indirect cost. It's basically all of the overhead, all of the electrical, the maintenance, the security, the taxes, the rent, basically anything associated with the manufacturing plant that we cannot directly trace to each unit we're making. And we got to come up with a cost allocation method to allocate these manufacturing indirect costs to the products. And more on that in future chapters. Prime cost basically is the direct materials and direct labor combined. So if you ever hear the term prime, that means the direct materials and direct labor. And if you hear the term conversion costs, that would be the direct labor and the overhead. All right, we need to spend money on direct labor and overhead to convert the direct materials into a finished product. Without adding labor and overhead, guess what? We have a pile of junk that's kind of useless and valueless. We got to put it into a finished good. All right, let me just stop on this question because I think it's important you understand cost behaviors. And basically, we're trying to analyze our fixed and our variable costs. And we've got three statements here, and we need to understand which one of these are correct and which ones are incorrect. So number one, let's think about it. As the cost driver level increases, basically as activity increases, total fixed costs remain unchanged. That is a true statement. Total fixed costs will remain the same regardless of activity. We can make 0 items or 1,000,000 items. As long as we're within that relevant range, the total fixed cost will remain unchanged. So number one, we can say true. Correct. Number two, as activity increases, fixed costs per unit also increase. That is false. There is an inverse relationship. So the fixed cost, remember, the total is the same, but as activity increases, the fixed cost per unit will decrease. So number two is not correct. And lastly, number three, as activity decreases, variable cost per unit also decreases. That is false. Variable cost per unit will always remain the same, regardless of activity. What will decrease is total variable cost if activity decreases. So make sure you understand how variable and fixed costs behave when it comes to activity. Activity increases and decreases. All right, in this example, we are deciding what is cost of goods sold for the year. All right, well, cost of goods sold will basically be, and we're assuming all of these costs have been finished on the assembly line. So cost of goods sold is going to be the sum of direct materials, direct labor, and all of our manufacturing overhead for absorption. See, it says absorption method. Absorption method is going to absorb all of the manufacturing overhead into the product costs. What you don't see is the selling general administrative costs. These last two, they are not part of the cost of goods sold. They are going to be part of the selling general administrative expenses in another section on the income statement. So be mindful of that. All right, absorption method is something to It is basically where all of the overhead is absorbed into the inventory, fixed and variable piece. Very important. All right, here we got a matching. Basically, we have two columns we need to decide. We have these costs over here, A through I, and they're explained. We need to decide two things. Number one, is it a direct cost or an indirect cost? Remember, a direct cost is when we can specifically trace that cost directly to a product without having to do some sort of allocation. Indirect means we would have to do an allocation to come up with a methodology to allocate costs to a particular item that we're making. And V or F is column B. That's variable or fixed. Remember, variable means the total is going to change as activity changes, but the variable cost per unit will always remain the same. Fixed cost is the opposite. Fixed cost in total will always remain the same regardless of activity, but the inverse approach, fixed cost per unit, will decrease as activity increases, and vice versa. So let's take a look here. What we have here is we have a marketing research firm. They organize focus groups for consumer product companies. Each focus group has 8 individuals who are paid $60 per session to provide comments on new products. These focus groups meet in hotels and are led by a trained independent marketing specialist hired by Market Focus. Each specialist is paid a fixed retainer to conduct a minimum number of sessions and a per session fee of $2,200. A market-focused staff member attends each session to ensure that all the logistical aspects run smoothly. Okay, so we have these costs here. We need to decide direct or indirect, and also variable or fixed. Letter A, payment to individuals in each focus group to provide comments on new products. Well, that is direct, right? We know which individuals are in each focus group and what they're commenting on each product. That's a direct. And it is variable. More individuals, all right? It's going to be a, it's per unit, it's per individual. So more individuals in the focus group. It's going to be the same per individual, but it may be different in total. So that's variable. Letter B, an annual subscription of Market Focus to Consumer Reports magazine. So we're making an advertisement for our business. We can't trace that directly to a particular focus group, so we need to do some sort of cost assignment using an allocation method, so that would be an indirect cost. I am assuming the subscription is the same regardless of how many focus groups we have. Therefore, it is a fixed cost. Letter C, the phone calls made by Market Focus staff members to confirm individuals will attend a focus group session. Well, there could be multiple phone calls or more phone calls, less phone calls, depending on our activity levels. Now, we can't directly trace the cost of the phone calls to each focus group, so we need some sort of cost allocation method. I would say it's more of an indirect cost. But on the other hand, it is fixed because usually, I'm assuming here, our phone plan is a fixed rate regardless of how many phone calls we make. Be careful here. This could be variable, but it depends on our phone plan. Letter D. Letter D. Retainer paid to the focus group leader to conduct 18 focus groups per year. Now, the focus group leader, he's getting one set amount. So it's a fixed cost, all right, regardless of his activity. It's a fixed amount. It's not going to change based on our level of activity. But in regard to direct or indirect, it's indirect. And the reason for that is because we know that he is working on multiple focus groups, sometimes at the same time, in the same day. So it's most likely an indirect. Letter E, recruiting cost to hire market specialists. All right. Once again, I would say the market specialists, they're not working on one particular product, so it's more of an indirect cost, and it will be variable depending on how many specialists that we hire. Letter F, lease payment by market focus for corporate office. I'm assuming the lease is a flat amount, so it's a fixed amount, and it is indirect. We cannot directly trace that lease payment to a particular focus group. Letter G, the cost of tapes used to record comments made by individuals in a focus group session. Well, each tape can now be directly traced to a particular focus group. That's a direct cost. And it will be variable. More focus groups, more tapes. It's not a fixed amount, it's variable, depending on the activity. Letter H, gasoline cost of market-focused staff for company-owned vehicles. Once again, we can't trace each gallon of gas used for to a particular individual focus group. So indirect, and it's variable. More focus groups, more gas. And last but not least, letter I, costs incurred to improve the design of focus groups to make them more effective. Once again, this is more of an indirect cost. And the author has here fixed. Yeah, maybe fixed. We have a set amount for improvement, but I would argue variable might work here as well. Obviously, if we have a larger rooms and larger activity levels, it very well could be variable as well. I would argue could go either way there. I'd need more information to figure it out. All right, here basically we're opening a small restaurant and we're on a very tight budget and we have to choose our phone plan. And we have 3 phone plans that we could choose from. Plan A, very simple, 10 cents a minute for long distance. Plan B, we could pay a fixed amount of $15 up to 280 long distance minutes and then 7 cents per minute after the 280. Plan C, a fixed amount of 24, so it's getting a little higher, but we get 460 long distance minutes covered in that, and then 5 cents a minute after. Well, let's see if we can figure out what we're going to do if we expect to make long distance calls of 100 minutes, 280 minutes, and 480 minutes. And so what we're going to do, you can see for each plan, if we did 100 minutes, remember it's a flat rate in plan A, 10 cents a minute, excuse me. So 100 minutes times 10 cents, 10 bucks. 280 minutes times 10 cents, 28. 480 minutes times 10 cents, $48. How about plan B? Remember plan B, it's a fixed amount of $15 up to 280. So 100 minutes and 280 minutes, you're just going to pay 15 bucks. And 7 minutes for every minute afterwards. And so if we have 480 long distance minutes minus 280, remember the first $15 covers the 280 minutes. We're 200 minutes over. 200 minutes over times 7 cents per minute, that's an additional $14. 14 plus 15 will give you 29. All right, and then plan C basically says that we can pay a flat rate of $24 up to 460 minutes. So once again, when we have 100 minutes and 280 minutes of long distance, we're just going to pay a flat amount of $24. But the 480, we're a little bit over the 460. We're 20 minutes over the 460. 20 minutes times 5 cents a minute, we got to pay an extra $1. 1 plus 24 is 25. So I would say if we think we're only going to spend 100 minutes long distance, plan A would be the cheapest, 10 versus 15 versus 24. Plan A would work. For 280 minutes, I would choose plan B, 28 versus 15 versus 24. So plan B is the cheapest if that's going to be our normal range. And if we plan on spending 480 minutes long distance, plan A is $48, plan B is $29, and plan C is $25. You can see that plan A is the correct answer in one situation, plan B is the correct answer in another situation, and plan C would be the best alternative in a third situation. So that's why you need to know. This is a very simple example, but this is why you need to know your business. You need to understand what level of activities you have and how that is going to affect your decisions. All right? There's not always one correct answer. It changes. All right. Here we're going to take a look once again at direct materials. All right. And so the author is asking us to calculate the cost of direct materials inventory as of March 31st. Well, the author tells us beginning inventory on March 1st was 105, plus we purchased 355 more direct materials during the month. So we had 460 available to use, but 385 was actually used, meaning it went over to the WIP stage. It got used in production. All right, 460 minus 385. The ending direct materials is 75. Okay, how much is fixed overhead for March? The answer is here. Total overhead was 495, the author told us, but 260 of it was variable. And remember, costs are either fixed or variable. If the total is 495 and 260 of it is variable, that means 235 of it is fixed. Okay. Once again, understand how costs behave. And requirement 3, calculating direct labor. Okay. So we know, the author told us, I can open this up for us so we can see. The author told us total manufacturing costs. Remember, manufacturing costs are 3 categories: materials, labor, overhead. Materials, labor, overhead. Materials, labor, overhead. The total was 1,610. We calculated above that 385 is for direct materials used, and the author told us that the total overhead was 495. So if the total manufacturing costs are 1,610, and we know 385 is for materials, 495 is for overhead, the remainder, or 730, is for labor. Remember the 3 categories of manufacturing costs: materials, labor, and overhead. And calculate WIP as of the end of the month. Okay, so WIP at the beginning of the month, the author told us, was 230. Here it is, 230. And we added 1,610 to the WIP process during the year. Total manufacturing cost incurred, 1,610. So beginning WIP plus what was added is WIP available for production minus cost of goods manufactured. That basically means the cost that came off the assembly line and went to the finished goods, 1,680. The author gave us that number. So WIP available for production less what went to the finished goods, or cost of goods manufactured, equals WIP inventory at the end of the year. And lastly, the cost of, or 2 more, cost of finished goods available for sale in March. Well, finished goods at the beginning of the month was 155. The author gave us that number. Plus cost of goods manufactured, we just calculated that above. That's the amount added to the finished goods. That gives us 1,835. And remember, we need that for our cost of goods sold calculation, which is basically the cost of goods sold is 1,835. All right, minus our ending inventory, or I should say, cost of goods sold, the author gave it to us, was 1,710. So if 1,835 was available for sale, and 1,710 is cost of goods sold, that means 125 is still an ending inventory. So making sure how you know all of the costs flow through the system. Once again, you need to understand there are 3 types of manufacturing costs. Those would be materials, labor, and overhead. There are 3 inventory accounts: materials, WIP, which is where the labor and overhead are added to the materials. And then ultimately, once it's finished, we have finished goods. And last but not least, I want to calculate a cost of goods manufactured schedule. And once again, to figure out a schedule of cost of goods manufactured, we need to consider our three manufacturing costs, which are materials, labor, and overhead. And we're going to go through for the whole year. So materials, beginning inventory plus purchases equals available for use minus ending direct materials equals what was used. And that means the $70,000 used was taken off the direct materials part of the warehouse and brought onto the assembly line. So that $70,000 was plopped on the assembly line, and we're going to add labor and overhead. All right, so 70,000 materials brought onto the assembly line, plus labor of 27,000, plus overhead. You can see there's four categories of overhead of 37. You add 70 materials, 27,000 labor, 37,000 overhead. That gives you total manufacturing costs for the year of $134. Add that to the beginning WIP, gives you total manufacturing costs we need to account for. If we count 20,000 in ending WIP, that means 139 has been moved over to finished goods. That is called cost of goods manufactured. And that 139 is used to calculate the cost of goods sold. Once again, and this should be a refresher from your financial accounting class, beginning inventory plus what was purchased, in this case, what was manufactured, the 139. That is cost of goods available for sale less what was not sold, which is the ending inventory, equals what was sold. Cost of goods sold. Subtract that from revenues, and you get gross margin or gross profit. And from there, you're going to subtract out your period costs or your non-manufacturing costs totaling 131. Subtract it from the gross margin, and you get the operating income. All right, so this is a very important chapter. It flows through, it shows the flow of all of our costs, both manufacturing costs as well as our period costs.